Hello everybody and welcome back to my investment series. This is episode 11 and as always we're going to make a trade first, then we'll review the markets, and afterwards I want to talk about a topic that has been dominating the headlines for a couple of years now, has pushed stock market valuations to unbelievable heights, and has also dominated this series. I'm talking of course about AI. So let's talk about it, how it might impact us and what to watch out for in 2026. But first, without further ado, let's make the trade. As always, I'm investing in the MSCI emerging markets and I have €1,000 ready. Now let's go ahead and put in €1,000 here and then review the order. Seems correct. Let's buy. And boom. Let's see if that worked. And yeah, I think it did. Already saw it. Perfect. Yeah, let's check the portfolio here. We are at €11,700 already. Wow, that's pretty impressive. So yeah, especially the start of the year 2026 has been, wow, impressive. Pretty amazing. All right, so much for my portfolio. Let's check out briefly what happened in the markets. All right, so let's see here. The market really shows a mixed picture. The MSCI World is down a little bit, led by the US, and the MSCI Emerging Markets is actually up quite a bit. There's not really one uniform story emerging, but yeah, let's go through a couple of interesting headlines here. So yeah, the stocks finished mixed here. It's a bit unclear here. TSMC seems to have a record fourth quarter, and it boosts the sentiment around AI. But other than that, here an interesting story was the Department of Justice was investigating Federal Reserve Chair Jerome Powell. And so there seems to be some concerns around Fed independence. Now, Trump, of course, doesn't like Jerome Powell, and he wants lower interest rates, but Jerome Powell doesn't want that, or at least he says he wants to be independent, and that's anyway what a Fed should be. They shouldn't be just changing the interest rates to the liking of Donald Trump. They need to follow their mandate, and so that's something to be aware of. So that's that. One thing that isn't mentioned here is the upcoming Supreme Court decision when the Supreme Court will decide whether Trump's tariffs were even legal. And a lot of people said, it's actually a tax on the US consumer, and because Congress wasn't involved, it's like an illegal tax or something. I don't know what it is, but at the end of the day, the Supreme Court will decide next week. And so Trump says, if they strike down my tariffs, I'm going to immediately impose a 10% tariff on everything. And that's because some section in the Trade Act of 1974 allows him to do that. Anyway, but tariffs is one thing to watch out for next week. So the only piece of economic news that I found about the US was that price inflation seems to cool in December, but not even that is a big deal. So yeah, not much interesting going on, in my opinion, in the US here. In Europe, we saw that stocks went up, supported by resilient economic data and earnings results, second week in a row. That's great. Now, the major indices were mixed. Germany and Italy went up, but France lost. And so, yeah, once again, confirming Germany is growing for the first time in 3 years in 2025 as households and the government increase spending. So I like that households increase spending. I don't like governments increasing spending. And Germany put out a special 500 billion extra budget that they want to use over the next couple of years. Whether that's good or bad depends on who you ask, but it seems to have been necessary. Then one more interesting thing in the EU happened, which was that there's a new trade deal with Mercosur. And this is a bloc in South America. And there was more than 25 years of talking, I think. But finally they got it through. And so that might provide some boost to the economy. Yeah, Japan is up pretty nicely. One thing that happened was Japan's prime minister is preparing to call a snap election. And investors seem to interpret this as follows: if the prime minister wins, it would provide greater certainty over political direction and would clear the way for more aggressive fiscal stimulus. Okay? Now, there's always two sides to a story, and that story also led to the yen depreciating sharply. And that's one more reason why the Bank of Japan could raise its interest rate sooner than expected. So, you know that we talked about this, they are increasing the rates, but now, because the yen is so weak, they might do it even earlier than anticipated. China. One thing that seems to have happened here was that markets declined after regulators tightened rules on margin financing. So, investors have to provide now a margin that is equal to the full value of the security they buy on credit. And in the past, they seem to have been able to do that with 80%. Okay, that certainly doesn't help the valuations. And in fact, China is down a little bit. The one good thing here is China reported that exports surged 6.6% in December, and there was an increase in exports to Southeast Asia and Europe, which outweighed the tariff-driven slump in exports to the US. Okay, good for China. Now that's about it for the market overview. I didn't find any compelling storyline, and the main thing I wanted to talk about today was AI. So, why do we want to talk about AI? Well, we talk about AI so many times in this series because it seems to be driving valuations all over the place. And whether AI is a boom or a bubble, that could have huge implications for us. And I'm not an AI expert, but I still want to tell you how I think about it when I invest. And we go through a couple of points here that might be interesting to you. And maybe next time you read about it in the news, you'll think, hey, I heard about that. That's interesting. And maybe you can interpret the news a little bit better. So we're going to talk about how economically significant AI is in the US. So all of this is, by the way, my US view. That is in part also applicable to other countries, I assume, but it's just such a pronounced phenomenon in the US. And so, we want to discuss whether tech companies can still afford those huge investments. Then the question, can we justify the big valuations in AI? And then the very important question, will AI change everything? Because that's almost what is required. And lastly, we talk about the power use, because that could also pose problems. So let's look at the economic significance of AI spending. And here you can see selected projects in US history and how much was spent on them. And so the spend is expressed as percent of GDP. Okay, and so here you see in the 30s, the Hoover Dam, the Golden Gate Bridge, some other things, it's super small. The Manhattan Project, about 0.5% of GDP. Electricity, so making electricity available in all households. The Apollo Project, sending a man to the moon, interstate, and all of that. Broadband, so internet in all households. All of that is dwarfed by the tech capex of the recent past. We're spending a lot of money on AI, and so it's definitely economically significant. But it is also significant for stock markets. Check this out. You might have seen this, but the Magnificent Seven have such enormous valuations here. Nvidia, Microsoft, and the others, they have almost 20 trillion in valuations in market cap. And compare that to Germany. So Germany, the entire state of Germany, with 80 million people, has a GDP per year of 5 trillion. But then meanwhile, you have Nvidia is worth, it's not the same comparison, GDP versus valuation, but just to give you a sense of perspective, what numbers we're talking about. So AI valuations are clearly through the roof. And AI has really boosted the S&P 500. So here you can see a chart where the Magnificent Seven are compared to the S&P 500. And the S&P 500 returned 12.3% over the last couple of years, but only because of those Magnificent Seven, which returned almost 21% per year. If they weren't in the mix and we only look at the S&P 500 without the Magnificent Seven, this is the blue line, the return would only be 8.7% per year. So it's significantly lower. And so clearly the market was driven by those stocks. And one of the problems is concentration. Now check out the red line here. This is the percent of the S&P 500 market cap that is made up of the Magnificent Seven, so those AI stocks. And this is now at, right around 35%. So a third of the index, the S&P 500, is the Magnificent Seven. And so the stocks went up all those years, but they don't always have to go up. We've seen that a crash can always happen. And here you can see the Magnificent Seven in 2022, they fell by, I think 50% here. And so imagine if that happened today. If they fell by 50%, that would wipe out 10 trillion in stock market valuations right away. Because we saw that those have right now a valuation of 20 trillion, minus 50%, 10 trillion. I mean, can you imagine that? That's crazy. So much for that. I think we made the point that for the economy and for the stock market, AI is a big, big deal. So now let's look at whether AI companies can actually afford all of those investments. And so here you look at the blue line. And the blue line is how much of a company's sales is invested into CapEx. So infrastructure spending, data center, and so on. So this is actually the Russell 3000 US tech companies. So it's not the Magnificent Seven. It's all tech companies of this huge index. And it doesn't say whether this is AI investment, but assume that a significant chunk is. And you can see that it's not like in the .com bubble when companies hardly had sales, but it is picking up. And companies are investing more and more into CapEx. And then you look at this chart here on the left-hand side, you see that the cash balances of those companies, Alphabet, Microsoft, Meta, Amazon, the cash balances are going down. So fewer and fewer of their assets are cash. That's probably because they've invested so much. It's not the perfect measure here, it's not just that, but at least they have less cash on hand than in prior years. So it's not automatically a problem or anything, but if you look at the right-hand side, you might be thinking, what's going on? So this is the long-term debt of hyperscalers. So the hyperscalers are those large AI companies. And this is the annual change in long-term debt, so bonds and so on. And this is somewhere between 20 and 50 billion. And that was the case for the last 10 years. And it was also in the first 3 quarters of this year. But now look at the Q4 figures here. Amazon, Meta, Google, Oracle, they took on 150 billion in long-term debt just in Q4. Now, it doesn't mean that they're in trouble, but it's changing. Something is changing here. So they're not going broke, but it seems to be that they don't have any funny money to play around with anymore. But now let's come to the topic of valuation. Are they actually worth it? So on the left-hand side, you see the PE ratio. And maybe let's take the blue line, the trailing PE ratio. And here we're crossing the 40 mark. So 40 times earnings is what you have to pay for these companies. And that's not as high as in the .com bubble, but I'm not sure this is a benchmark you want to look at. I mean, the .com bubble was just crazy. But so now, compared to the recent past or the last 10, 20 years, it's actually a high valuation, a very high valuation, and you can be concerned about it. Now, some would argue, it may be high, but it's also about the growth. And this is when a new ratio comes into play here. You see, the PE ratio is only one thing, and it's a static ratio. The PEG ratio also factors in company growth. So on the bottom here, you see a formula where you see the PEG is the PE ratio divided by the growth rate. So let's say you have a PE ratio of 30 and a growth rate of 20%, then you get a PEG of 1.5. And so it's kind of logical, it's kind of natural. If 2 companies have the same PE ratio, but one is growing like crazy, maybe I rather want to own the one that is growing a lot. And by that metric, you see that the valuations are not crazy. at least what we have here, is the MSCI All World Equity Index for Information Technology. So the brown line, it's not out of the ordinary. The only thing here that I find concerning is the metrics that they're using. So here they have the year 2 forward EPS growth, so the earnings per share growth. And honestly, this is such an obscure metric. I'm not an expert here, but it just feels like you could cherry pick anything here. And why do you take the year 2 forward EPS growth? I don't know. Anyway, aside from valuations, I think what everyone is betting on is that AI will change the world and that all the companies will adopt it. It will provide huge productivity boosts, and so we're all happy. And yeah, that's what needs to happen, and that's what we need to see to believe those valuations. Now, here are some interesting studies. First, I'm going to show you this study here, and it's a very negative one. It's done by MIT. It is survey-based, and they ask companies how happy you are with AI. And actually here you see it's very negative. So they say AI doesn't learn from our feedback, you need to give too much context, you can't customize it, and it always breaks in edge cases. And here they say 95% of organizations are getting zero return on their investment in Gen AI, and the CEOs are becoming less confident. So that's pretty bad. But then there are also other studies. Here you have one by Wharton, also a great institution, pretty close to MIT. And here you can see, just look at the left bar here, and you can see that 35% of companies reported significantly positive ROI on Gen AI investment. So the return on investment is significantly positive. Then there's another 39% here that say it's moderately positive, and then 9% who say neutral, and only 3% say they have a negative return on investment. Okay, so the majority of companies, the vast majority, has a positive return on investment. And so what's going on? Well, the problem is that both of those studies are surveys. And so the one survey has a very negative outcome, this one has a very positive outcome, and you can't really trust surveys, they're useless. I think the proof is in the pudding, and we need to look at stock market valuations. And so here you can see that there are two different stories. And so the blue line is AI infrastructure companies. So the semiconductor companies, the tech companies, and they are really benefiting. Their share price is through the roof. But then you have companies that have AI-enabled revenues. So software companies that try to generate revenues with AI. Or companies, and this is the red line here, companies that have a high labor share, and they could have the most benefit from automating workflows with AI, and so reduce their costs and become more profitable. Now, both of those groups didn't really see any stock market returns versus the AI infrastructure companies. They have a huge return. So it remains to be seen whether all these other companies will actually experience productivity benefits or increased stock market returns. In the meantime, what we can look at is AI revenues by the AI companies. So even if the customers of AI or the broader economy don't yet see the benefits, if the AI companies can increase their revenue substantially, it would validate the story and it would validate the valuations. And so it's a bit hard to create this chart. Here, JP Morgan, Bloomberg, they tried to do it. Oftentimes in financial statements, you can't really say this is AI or this is not AI. This is all a little bit jumbled up in the financial statements, but it seems to be some indication that there's an increase in revenue with AI. But they need to accelerate this. We saw before that their cash balances are dwindling, and so that's the one thing for you to watch out for in 2026. We need a clearer path to profitability on AI investments. So that's what we need in the short term, and I think 2026 might be a make or break year. But there are also other problems, and they are more in the mid to long term. And I'm talking about energy. Energy might really be the bottleneck of AI in the long run. The chart on the left-hand side shows the growing power need to train AI models. And here we have the frontier models, so they are the best at any given time. And yeah, power required to train frontier models has doubled every year. And so next year, when the state-of-the-art model is trained, it's going to use twice as much power as the top model this year. And so what that means is we're going to need a lot of investments in electrical power. And the right-hand side chart shows some interesting stats. So how much construction spending do we have on different categories? Electric power is going up, so we need more electric power. Meanwhile, office building investments go down, but data centers go up. So yeah, you probably don't need to go to the office anymore if an AI does your job. Now, how much capacity was added recently? This is a chart that goes up until 2024, and in 2024, only 25 gigawatts was added in power capacity. Actually, there was more additions, but a lot of it was solar and wind, and you cannot take them for 100%. You know, intermittency, reliability, you don't have the sun at night. So 25 gigawatts was added. Remember that number. So that's the broad story around the US. But there's also companies making moves. Here you can see Microsoft has decided to restart a decommissioned nuclear reactor at 3 Mile Island. And yeah, they're going to have long-term energy supply. It's twice the national average in energy costs, but you know, they don't care. They locked it in and they can work with that. But check this out. OpenAI has announced projects together with a couple of companies here, with Oracle, AMD, Broadcom, and NVIDIA. And the data center power demand from those projects alone is more than 30 gigawatts. Okay, 30 gigawatts. Compare that to the 25 gigawatts added capacity in 2024 in the entire US. So OpenAI alone has, well, over the next couple of years at least, this huge need. And on the right-hand side, you see nuclear power plants built over the last couple of decades. And that happened mostly in the 70s and 80s, maybe 90s. And at its peak, nuclear added between 30 and 40 gigawatts per year. And since then, there's almost nothing anymore. So it's really hard to build out nuclear. This is always more expensive than anticipated. It always takes longer than anticipated. So it's not totally easy to build out nuclear, although it is super important for the energy system, I assume, in the future. So yeah, don't think that nuclear will save the energy crisis here. What else is there? Of course, there's natural gas. And so here what you can see is over the last couple of years, the global gas turbine orders. And if you look at the future projected bars here, you can see that the gas turbine orders are projected to be way higher than in the past and actually above the current production limit. So you actually need to ramp up production of gas turbines to just meet the demand there. So where is this all gonna go? This is a projection for the data center capacity, so the electric power that is needed. And it has gone up already quite significantly. Here it's right around 40 gigawatts, but it's projected to reach more than 100 gigawatts by, I don't know what it is, like 2030 maybe. So yeah, we need to add like 60 gigawatts for data centers alone. And the entire US, once again, added 25 gigawatts in 2024. But this might not be the end of it. So Sam Altman apparently said that the ultimate goal is 250 gigawatts by 2033. And that's 1/3 of US power consumption. I mean, that's insane. So something needs to change really dramatically that this can happen. One thing companies might be doing is bring their own generation, bring your own energy. What if you generate the energy yourself? Right now, only 1% of data center owners do that, but by 2030, it's expected that 38% will do that, at least partially, and 27% will fully rely on their own on-site power. Only problem is that you have long lead times because you need the grid interconnection. So that might still throw a wrench into that plan. And yeah, here on the right hand side, you see how that could look like, different cost curves, and you could be doing this with natural gas only or also with solar and batteries, different combinations. It tends to be more expensive than what you would get from the grid right now. But at the end of the day, if you don't run your data center for a couple of months, you might have such high opportunity costs that it might be worth it to build your own generation. And so I think you can summarize it as power could really be becoming a big problem for the AI story in the long run. And on the left-hand side, you see the supply and demand gap. The supply needed, the brown line here, versus the supply anticipated. There's a huge gap that is opening up until 2033 or something like that. And so that's a problem. But now let's look at the right-hand side. And here you can see the electricity generation of the US over the last couple of years, and then compared to China. And you see that China is totally crushing the US here. Now, this could be a long-term problem for the US and could really be a benefit for China. I will talk about US versus China in an upcoming video, so see this as a cliffhanger. China is really great at this, but are they great at making chips? And what else is going on in their economy? So this is for a future video, but I think we can now come to a summary when it comes to AI. So AI is really huge, and the AI story can make or break equity markets. And we saw that they can go down, and they make up such a big portion of the market that if AI companies sneeze, the rest of the market catches a cold or pneumonia. I don't know. However, it is unclear whether the benefits of AI to the rest of the economy are real. We saw the different surveys. Some are really quite disillusioned. They say, nah, I don't get a positive return of it. And others are saying, yeah, I get a positive return. So far, only the AI companies have benefited. But what they need to do is show success, show financial success, show revenues from AI. And that's the one thing you can watch out for in 2026. If they don't start making significant money with AI, then, maybe they are overvalued. Assuming everything goes right, we might see a continuation of the bull run. But in the midterm, so in 2 to 5 years, we might see another problem, which is an energy bottleneck. So with all of those growth projections, we also need to build out energy. And if we don't do that, all of those data centers are not going to happen. So those are all the things that you might be paying attention to. But ultimately, what I can say and how I think about it is you don't know what's going to happen. It's too complex. And if you're just scared, saying, the next crash is on the horizon, the next crash is on the horizon, you probably would have sat out the last couple of years. And meanwhile, we're up 100%. So my philosophy is time in the market beats timing the market. And all you can do is keep investing, take a long-term view, and don't stress about the short-term fluctuations. Okay, guys, that wraps it up for this week. I might be making more such videos in the near future, but I will definitely make my trade, and I hope to see you next week. And until then, take care and all the best.